Hello and good morning. Welcome to another podcast with Martin and Shawn, with Note Investing Made Easier and coupled with Bequest Funds. And we have a very special, very interesting, we have, to say the least, and obviously we're very far from being beyond this pandemic. However, with that said, like you out there, we were making a lot of moves at the time COVID hit. For one, we were in the process of obtaining financing and locking down our headquarters space. Here we are, by which we were set to do a whole construction renovation project where we had money out on materials and everything else. We were involved in two trades. I believe two sizable trades. We were staffing up. We had just hired another asset manager. And so a lot was going on, I say, to say the least. So we had to make some decisions, right? Some decisions. Do we move forward? Do we advance given the fear, given the climate? And so I think that's a good starting point is what to do with this thing called fear, especially given a pandemic. What would you say to that?
Yeah, absolutely. I mean, during the middle of the pandemic, fear was real, right? And if we dwelled on it too much, I personally found myself like kind of shutting down, not thinking about the same dreams and aspirations I had just a few weeks beforehand. I kind of shut down and personally thought, well, all of our plans have to change. There's no way that those same dreams that I had 2 weeks ago are the same dreams I'm pursuing now. And so if I didn't focus on the same mind perspective I had just before it started, I found myself shutting down and not wanting to move forward on all the same aspirations I had just weeks prior.
Yeah, and it was a very critical decision because we had to say, okay, we had trades that we were saying, hey, some of these notes in some of these states we don't really want anymore, right? or we don't want at the pricing that we had them set up at, and had the bid approved, and so. But on the other side, we're like, we need to go through with these trades. Yeah, we need to honor our word, and that's everything in this industry. So that came at a risk.
Absolutely. And, honestly, we've always been bullish on the housing market, which is why we're in this space, right? We believe in the U.S. housing market. We believe that supply is still, years behind demand. And so it questioned the fundamentals. Like the reason we're in this business is because we believe housing will continue to be strong for years to come. Does that stand true? Like in the middle of the pandemic, we were questioning ourselves, like, is the housing market going to survive this? Are the same fundamentals that we believed, last month, do they still ring true today?
So from that perspective, we had to do a deep dive, as in, many folks in the industry. We had to look at every aspect of our business. So we knew that, moratoriums were starting to come out. We knew that the country was shutting down in many respects. So we had to focus on the other, 99% of our operation outside of legal, outside of, pressing forward with foreclosure and on our non-performing notes. And so starting with sourcing, right? Starting with, notes that we were looking at going forward. How is the moratoriums affecting those notes, those note pricing? How does it affect the competitive landscape? We found that in some cases, some of the bidders, dropped out of bids while we kind of stayed in as well. And So, decisions made on the sourcing front.
Yeah. We definitely saw, especially in April, definitely saw the competition drop off, right? They weren't there anymore. And so sometimes when we know that, we're like, do they know something we don't know? Right? We're like, are they smarter than us? Are we making the right decision by being in these trades? When we look around and our friends, because they're friends of ours, they're not there, right? And so the sourcing piece,
or they're not buying at the same levels, or something.
They're not buying at the same levels, and so, but for us, it turned into an opportunity. I would say on the sourcing side, because sellers still wanted to sell, and there was few of us buyers sitting at the table still. Honestly, I think it helped us create stronger relationships.
Yeah.
Because we were there when our sellers needed us to be there. Right?
Yeah. And I think right now, where is it at now? I'd say it's a huge, it's going to be a huge seller's market for some time to come. I know that, folks reach out to me, especially on the newer side, and they have this notion that there's just going to be bombarded with inventory over the next few years, and it's going to be big harvest phase coming up. But I think for at least for the next 6 months or so, I think pent up buyers that have capital, that have debt obligations, cost of capital, etc., they're going to be coming out, and I think they're going to be driving up pricing for a while, in my opinion.
Yeah, I would agree. There's a lot of folks down on the sidelines for the last 2 or 3 months, and luckily for us, we didn't. Right? We didn't sit on the sidelines. We stayed in the game because we believed in the fundamentals. But those folks now believe what we believe, and that is that houses can continue to be strong for years to come, which is the assets that we're buying when we buy non-performing notes. So I believe the same thing. I believe there's a lot of pent-up demand out there, and so now's the time to sell if you got assets to sell.
Oh yeah.
Right?
I believe so, at least for the short while. And it's going to take time if there is any COVID distressed assets, coming down the pike. It's going to take a while before it filters down to, the mid-level, lower level tier. But, switching gears to the reperforming loan side. So these are loans that, at one point were distressed, but now they're performing and starting to season, if you will, and back into a performing loan status. So for these loans here, what we were concerned with is collectability percentages.
Yeah.
So what percentage of your reperforming loans are you collecting on, and what percentage are defaulted? And so normally, we like to keep above 10%, default rate, and less than 10% of a default rate. So whereas 90% and above of our reperforming loans are performing, and so we had anticipated drop down to 80%.
Yeah,
I think that was very, very realistic, and we were hoping that would be the extent of the drop.
Yeah, we were hoping that we felt like the portfolio of reperforming loans we had was still solid. We did think that we would move to an 80% performance based, but our fund can handle that, right? The fund was built to kind of handle a default rate, and we didn't think we were going to have any problems, even though 8 out of 10 loans, or two out of 10 loans, we're gonna fall off the wagon. And so we anticipated that, we prepared for that, but we didn't see that, did we?
No, we dropped down to 89% collected in 1 week during when we track this weekly. So we're we are all over monitoring our RPLs. That's your bread and butter. It's not a set it and forget it process. So you have an RPL, cradle to grave, right? Grave is when they pay you off. So you have to keep it in the cradle. And so we dipped down to 89% collected. So in other words, 10% default rate just for 1 week. And then it bounced back to where it was normally about 92% collected. And now we're hitting about 93% collected. So our percentage collected is higher now than it was pre-COVID, which again, we're not naive and we're not thinking a panacea, but we are pleasantly surprised, I'd say.
Yeah. And, listen, we did work with our borrowers, right? We had some call in and there's a human factor to this business that is real. And so we definitely worked with our borrowers to kind of help with the situation and push back some payments. We deferred some payments. We helped some folks find refinancing, right? So we were there for them during the pandemic, which, I think is a differentiator versus, a large bank who, probably you couldn't even get them on the phone because their lines were so packed.
Yeah, and we solidified our COVID process with our asset managers. So everyone understood when you get a call in for a COVID for forbearance request, there's a process that needs to happen, an application process along with supporting documents. So we systematized something that we've never experienced and other folks haven't experienced in the industry, and we felt like that helped give relief to those that are in need of it, and not wig out on someone that
absolutely
otherwise. So our lights are auto censored lights.
We're trying to save electricity, right? When nobody's here. We're being very conscious of our.
So let's move into due diligence was very interesting, and we're still going through moratoriums. And look, for those of you out there that have notes that were in the middle of foreclosure, or you want to start foreclosure and you're in states, these notes are in states where there's moratoriums preventing the start of foreclosure or the continuation of it. It's just a reality of it. I think that you have to consider that on trades going forward, though.
Yeah, absolutely. So we purchased pools of assets last year, and when we're in the middle of working on these pools and you have a pandemic like this and the court shut down and moratoriums, that definitely impacted our ability to move fast, right? We're definitely slowed down during the pandemic. And so what we learned on those pools, we're now applying to due diligence when we're actually looking to buy notes. And so we know exactly what's going on in the states that we operate in. We know what we can and can't do. We know when new decisions will be made. And so we're on top of everything that's going on in the states that we like to operate in. And so that same information is informing us on trades that we're in right now, right? Trades that we're looking to close right now. We know what's going on in states like Florida or California or Michigan, Pennsylvania. Like we know exactly what's going on when the deadlines, when the decisions need to be made by the governors or whoever is making the decisions, and that's informing our due diligence process.
Yeah. And kind of switching gears to asset management, we're doing, we're having good correspondence with our legal partners, and we're finding out, in some cases you can't initiate foreclosure. However, you may be able to send out a notice of intent letter or do some other type of communication outreach with the borrower that may bring them to the table where you can have, serious discussion about how you can help them out. So we're looking at, everything that we can do. Obviously, we run everything by our legal partners, but everything we can do within the law, we'll do it, because, our objective is to help homeowners stay in their homes with payments they can afford. And so we need to have a dialogue going to be able to understand what they can afford.
Yeah. What's interesting is the old telephone seems to still be working.
Yeah.
Right. Just because you can't send, start legal on a file doesn't mean you can't make a phone call and find out what the situation is. And honestly, during these last few months, the phone call has been our best tool.
Mm-hmm.
The phone itself has been our best tool for getting borrowers back on track. Not the demand letters from legal, not the complaints being filed. It's really been just making a phone call. Our asset managers reaching out. It's been working very well.
Mm-hmm.
And in fact, we kind of had our best.
No,
month.
forget. We kind of had our most profitable month, our best month as a company occurred last month in July. So in my 7 years of doing this, Shawn's 4 years, most profitable month by far in terms of loan modifications and payoffs occurring.
Yeah.
Because that's really what is happening out in the marketplace now. Cost, refinancing, cost of money so cheap that, loan officers are inundated with requests for refinancing. And hopefully your notes are in their queue to be refinanced.
Exactly. So yeah, things have been great. Right now you can't wind your lawyers all up. But honestly, that's not a bad thing right now. The phone call has been the best tool for our asset managers.
Yeah. And you have to be watching all, again, this should be a time when you can do self-reflection. You can look at every component of your business, start to work on your processes, start to become more efficient. One of the areas that we look into more now is all the legal invoices. Now, obviously, we let the legal invoices roll. Attorneys need to do what they need to do. You need to pay them. Yeah. Don't be cheap. But an attorney shouldn't be starting phase one of foreclosure when they're not able to file a complaint, and they shouldn't be ordering title when there's a rolling moratorium, exactly. Whereby that title could be outdated.
Right.
And then so don't let me see that you ordered title twice, right. Because you were trying to stick it to me on the front end. And so just things like that. But most legal, and I'm not throwing legal under the bus. We have like incredible legal partners that we love.
Absolutely. And
we take care of. And but you just have to kind of watch what everyone's doing, all your partners in the industry. You have to keep close communication with sellers. So let me ask you a question. And this is something that I talked about to people that I talk to, people that I mentor in the industry. And that is, it was my thought from the very onset of COVID that this is going to mark the year. 2020 will be the year of the year of networking and connectivity like we've never seen. You will be able to reach people that you normally would not be able to reach because everyone is at home. Yeah. What is your thought on that?
No, I completely agree. A lot of folks that I've network with over the course of the past few years, normally I see them like 2 or 3 times a year at specific conferences that I always go to because I'm like, I know I'm going to see this person and this person, and that's why I go to that conference. And honestly, those same folks may not be at a conference, but it now gives me an excuse to pick up the phone and call them instead. And honestly, I think our conversations are better, right? Are better now than just kind of meeting somebody at a conference. But I agree with you. People are available right now. Maybe getting less now that people are getting back to work a little bit more. Mm-hmm. But during the pandemic, you call anybody. people pick up the phone.
Yeah.
And they were very fruitful conversations. Very, let's figure out how to work together. Let's put a deal together. Let's, do whatever I needed to do with that strategic partner. Everybody was all ears, right?
COVID was, however you want to look at it, in your mind, but it's been a very humbling experience for everyone in the world, I would have to say. And so, take someone who may be sitting in the corner office and barking at people all day and brushing people off that try to call and reach out to him or her. And now this person's at home, right? And they're in their bedroom working out of their home office or whatever wherever they're situated. And their phone rings and they'll be like, oh, do I go play with my kids or do I talk to this prospect? And, they'll pick up the phone for you now. And, that may not be every case, but yeah, I do think that there's going to be a lot of new relationships forming out of COVID.
Absolutely.
So it's a good time to really just kind of set your businesses up. If you have a business, refine what you have and sharpen your saw, as Stephen Covey talks about.
Yeah, and honestly, for us, the same fundamentals that we believed in before the pandemic, we believed in during the pandemic, and amongst all the noise, right? Because there was a lot of noise, and you could have listened to all that noise and taken it all in, and changed what you believe, or you can continue to block it out. And the same fundamentals that drove your business in Q1 of this year should still be driving your business now. Yeah.
Amen to that. I know you run the trade desk, and you're going to be looking at trades up and coming. I would be content sitting out the rest of the year on as we picked up a lot of notes earlier this year, and I do think it's going to be a little bit of a frenzy as people kind of get back into the space. So good for Paper Stack, good for, Loan Exchange and all those other guys and gals out there, hustling, putting pools out, selling notes and everything. I think you're going to close out pretty well this year.
Yeah, absolutely. I completely agree.
And, we're going to continue, growing our income fund. We've been taking on new investors, and, hence the hat, 8% matters. And so, we're doing our thing. If, we can be of help, or you have any questions about BQuest, please reach out to info@bqfunds.com. And we appreciate your time today, and be safe, be good, and be prosperous.
Sounds good, Martin.